All right, thank you very much. I appreciate the introduction. Again, my name is Alan Knuckman here. I'm here in Chicago where it's a bit chilly. So we've seen the markets warm up over the past couple of days. Hopefully we'll see the weather warm up as well. Today we're going to talk about a couple of things that I think that are important. Trading is trading, and we'll get into that. But I want to talk today about how to use the best vehicles to take advantage of what the markets have to offer. And that's something that I've learned over the last many years in the marketplace. Now, first off, I want to state that this is the best time in history to be in the markets, and I use the word trading interchangeably with investing. Trading is not a negative connotation. It's not a negative term. Actually, it's a positive. It's a compliment. If you're viewed as a trader, you have a plan of entry, a plan of exit, and a risk control plan, versus an investor typically doesn't have a plan. They want to make money, but they don't have a plan to do so. So I'm always going to be opportunistic and optimistic about these opportunities, up, down, or sideways. There's money to be made in the marketplace just using the right vehicles and the right tools and the right risk control to take advantage of whatever the markets have to offer. And that's where discipline comes in, and trading is all about discipline, and it's all about risk control. A professional trader, the difference between a professional and a novice is a professional always focuses on risk. What is the risk? What is the worst case scenario on the position? How does it impact that position? How does it impact my portfolio? How does that impact me psychologically as far as viewing new opportunities? This is not gambling. This is about probability in trading and risk control and money management. Now, you had mentioned that I do regular television. I don't look at that as a positive so much. A lot of times people are watching TV and it's not helping them come up with good actual trade ideas. It's not helping them make money. A lot of the information that you get on TV is more infotainment than anything else, and you've got to learn to filter through the nonsense and the noise to get good information and good trade ideas. Remember, their job on television is to sell advertising, not necessarily to help you make money. But I hopefully can break through the crowd by getting on and mentioning actual ideas, things that I'm specifically looking at, what to get into and where and what to risk, because that's the most important thing to take away from watching. Now let's talk a little bit about where the markets are and where the markets are going. First off, the market, the S&P 500 is the market. That's how everything is scored. The performance against the broad market, you can see we came down to that support at 2000, bounced off one more time. You've got to respect the resiliency in the upward movement of this market, regardless of what happens, regardless of the crisis du jour. The market's been very positive and recovered each and every time until it doesn't. And if you feel like you missed out on an opportunity, don't do that, because right now we've been in an uptrend for the last 5 years, but there will be more opportunities if and when the market does turn to the downside or start to trade sideways. We just have to take different tools out of our toolbox to take advantage of what the markets have to offer. But look at that resiliency, look at that move. I'm not one to say that the trends are over or to pick a top of the market. There's been a lot of casualties for most people that are saying this is the end or there's a crash upcoming. If the market does change direction, we have stops in place. We have risk control in place. Again, the focus is on what is our worst case scenario on each and every position, and it's something that we can live with. It's about money management. It's about asset allocation. It's about portfolio management. So no one trade hurts you. Again, to get back to the gambling, this is not Texas Hold'em. This is not all in where you're putting your whole account on one trade. This is about probability and being able to be there for the long-term success, not the sprint, but the marathon. Now let's look at the Dow Jones. The Dow is just 30 stocks. The Dow is not weighted by capitalization. It's weighted by price, so it's not really a fair index. The Dow finally played catch-up, and it was amazing that it went from negative in October to actually positive 8% on the year. And there's the leader, the NASDAQ. Now, what's interesting about the NASDAQ here, and I'm just giving you a little background on where we are with the markets, then we can talk about the strategies and how to take advantage of them. But I've got a certain amount of optimism, obviously because of what has happened here in the past. The NASDAQ has gone up significantly over the last couple of years, and again last year led the way when nobody said it could or should. The markets can do whatever they want. The markets don't know high. They don't know low. They don't know how many years they've been up. They don't know how many years they've been down. Those are all human measurements and human emotions, and emotion often gets you in trouble. The trend, the strength in the NASDAQ is still strong. The NASDAQ did not make new highs the last time the stock market did. Actually, it's been since November 28th that the tech has made new highs. But if you look at the distance of that sell-off, added on to those old highs, when it does make new highs, we still got about 5% more on the upside in the near term. So that's a little rundown on the market, but again, the S&P is what we focus on, and I look for significant gains in the S&P. We're coming into earnings season, and these markets are earnings driven. Now, people argue with me and say that it's driven by the Fed. The Fed has been at this game for years and years and years. They do what they do. The markets are a measurement of earnings. The corporations are doing fantastically well. The economy is starting to come along as well. But let's remember that the economy and the markets are two completely different things. Two completely different things, and that's what you have to remember. I know people stress that, oh, this is still weak in the economy, this is still weak in the economy. Let's look at corporate performance. Let's look at stock momentum. Let's look at earnings, and that's been the focus. And earnings right now are still at a very modest level considering the price we're at. So I want to talk today about opportunity vehicles. The vehicle that we're going to talk about exchange-traded funds and that revolution. But typically, what has happened in the history of learning how to participate in the marketplace is most people started by selecting their mutual funds or selecting their funds for their 401k or the IRA for their retirement. And then maybe they would venture into individual stocks. Then maybe they would move into commodities and or currencies. But now there's been a revolution. There are exchange-traded funds that pretty much track everything. And they have many, many benefits. And then people branch into options. Now, like I said, trading is trading. Trading is about discipline, and we're going to talk about that in a second. But you want to trade the most appealing, the most beneficial vehicles. And that's where we're going to talk about exchange-traded funds today and options on exchange-traded funds. The revolution in exchange-traded funds has changed the ballgame forever. You can trade the stock indexes. We just looked at the S&P, the NASDAQ, the Dow. There are indexes, the diamond, spiders, and Qs that track that very closely. The key here is if you're going to trade these indexes that you're able to diversify your risk. You don't have individual stock risk. You're spreading out over a basket of stocks. So if one stock goes bad, the others typically will smooth out that performance. What's very revolutionary is that with mutual funds, you could only get out when the market was closed. You could have them close out your mutual funds the next day. With these ETFs, you can buy or sell at any time during this session. And also the management fees are minuscule, essentially not there compared to mutual funds, which charged you for that basket or whatever fund you were in. This changes the game forever. This has revolutionized the markets. Now, in addition to being able to trade diamond, spiders, and Qs to track indexes, there's many other indexes. You can pick specific targets. You can target regions, stock indexes in certain countries. The German ETF, the EWG, the Japanese, the EWJ, if you want to target a specific sector. FXI for China. You can also target resources: gold, silver, copper, coal, corn. Instead of participating in commodities, there are ETFs that have some advantages. You can also participate in rates, currency rates: the Canadian dollar, the Australian dollar, the euro currency. You can participate in interest rates, the 10-year, the 20-year interest rate. So there are many products. It's not about what you trade; it's about how you trade. And I think ETFs give you the what and the how. So typically these are very, very liquid. We want to make sure there's a lot of buyers and sellers, and that's been a revolution in the marketplace. When I say now is the best time to get involved in the markets, there's many reasons. One is we've got tight spreads. A lot of markets trade in pennies now, so the cost for you to get in or the cost for you to get out is very minuscule in comparison, whereas in the past it used to be 12.5 cents. Now it's in pennies. So you can execute your trading plan very efficiently. So whenever you want to get in, there are plenty of people that want to get out. Whenever you want to get out, there's plenty of people that want to get in. Also, commissions are extremely low for you as a trader compared to what it used to be $100 a trade at Bear Stearns, a dozen years or so ago. Things have changed. You've got electronic trading, so you can enter and exit at your leisure from wherever you are. You have got the same access as the professionals do, and you've got the same tools now that the professionals do with the charting and the data and so forth and so forth. So it is a great time to participate. Now that requires discipline and a plan. And the plan includes risk control. The risk control revolution is key, that you can figure out how much you want to risk in dollar terms or in percentage terms on each and every trade before you can get in, and you can control your probability by doing so with options we're going to talk about in a second. You want to have a very simple investment plan. I'm here, we're going to be using 2 vehicles to simplify our lives, not make it more complicated, to simplify our lives. And we want to use the same process no matter how we trade or any financial transaction in our life. It's a ridiculously simple process. You identify the trading candidate, you execute with money management plan, how much you're willing to risk on it, when you want to exit if it goes for you, when you want to exit if it goes against you. Then, as the markets move, you adjust your protection, you lock in some of those gains, move up your stop loss, maybe get out of half your position, so forth and so forth, to manage so that you can maximize the trend and repeat. That's it. Every single trade is the same, regardless of what market you're trading, what time frame, it's the same process. Identify, execute, manage to maximize, then repeat over and over and over. So trading is not what's fun. Making money is what's fun. Trading is methodical. Trading should be somewhat boring and should require a lot of patience, because patience is your #1 asset. You don't have to trade every day. You don't have to trade every hour. You can wait and look for your opportunities and pick only the best of the best. So let's talk about our objectives and how to do that with the right vehicles. So we want to invest intelligently. Like I said, I want to give the markets, I want to be able to take advantage of whatever the markets have to offer. And I want to make this ridiculously simple. And to do that, I also want to have less risk, put up less capital, and I want to not have to watch the markets minute by minute, day by day. The way that I participate in the markets now, based on my lifestyle, as a one-time active trader, I realized that wasn't as much fun as I thought it was. I like to step back a bit and look at things on more of a weekly basis, and not have to be tied to my computer, not chained to my computer watching every tick. Because the reality is, watching every up and down does not, let me repeat that, does not help with performance. You know, you've got your plan in place, and actually what it does, it oftentimes causes you to stray from your plan. You hear something on CBC, you see something on the screen, you want to change your plan, you don't stick to your discipline. So I want to have less time involved in the markets. Let the markets do the work. I'm going to do what I'm going to do, but I don't want to work for the markets. I want the markets to work for me. And with options and these ETFs, we can look at generating greater returns than just buy or sell. So let's talk about using the ETFs to trade the market like never before. The revolution, we talked about the spiders. They cover the S&P 500. The diamonds cover the Dow, and the Qs cover the NASDAQ. Now, everybody should be familiar with that, but there is a ETF essentially on anything and everything. But the key here is to use options on those ETFs, exchange-traded funds. Now, options I'm going to do very, very simply, ridiculously simply, actually laughingly simply, to attack the markets. Just buying, and I'm going to show you my stock substitution strategy where you're using an option as a vehicle instead of the underlying ETF. The idea with options and the advantages with options, you control your probability. You choose what probability. You want a 70% probability? You want 75? Do you want an 80%? Or do you want a long shot? Do you want a 5 or 10% probability? I don't play that game. I don't look at the low probability plays. I only want to look at plays that have a high probability of performance. And there are trades in each and every market, whereas if you're in the stock market, you can go up, you can go down. There are trades in options to take advantage up, down, or sideways. And again, controlling that probability so I can make that choice. Also key are limited risk strategies. These option strategies that I'm going to show you today have absolutely, positively, without a doubt, limited risk. No matter what happens, heck or high water, your risk is limited in these option strategies. We're going to use options to increase our returns. The leverage of the options is a positive leverage. It'll work in our favor when the market moves in our direction. And also, the key here is staying power, that you've got the ability to ride through some ups and downs. You're looking longer term at a period of weeks and months, and maybe even years. I'll show you some long-term positions using options as the underlying vehicle. But the question is, which option, which strike gives you the best probability and staying power? So the idea is to select the right option with more time than what you need. Now, my trading friends often, give me a little bit of a poke about, some of the positions that we have on are January of 2016 that were put on, this fall and maybe even this summer. So those options had a year and a half of time. The idea here is I may not use that year and a half of time, but because volatility was extremely low, those options were very, very cheap in comparison to what they were, months ago or years ago. So I would be silly not to buy more time than I need, because that's where people get themselves in trouble. If people have dabbled in options before, and a novice often buys too little time and buys something that's out of the money that has a low probability of being successful. Here in Chicago, we call those lottery tickets. If you go here to the exchange, you'll see some of the best sports cars and luxury cars ever. These guys sell out-of-the-money options with little time to be right. They sell the lottery tickets to novice traders. The novice trader needs a spectacular move in a very short period of time, and as we know, that very, very, very rarely happens. So they sell those out-of-the-money options to those novice traders, and they look to expire worthless. They keep the premium. A lot of these guys have made their living for years and years and years selling these out-of-the-money options. So we'll talk about how to buy the right amount of time to take advantage of our expectations in the marketplace. To do that, we're going to use a very simple strategy. Simple is often the most efficient. I'm not using options for the sake of being sophisticated. I'm using options for the sake of a trading vehicle. They are simply our trading vehicle. Instead of buying the stock, we're going to buy an option. Now, I'll show you which option in a second, but there are many variables that we can control. We can control direction, we can control the price, the time, and volatility. These are all factors that impact the option's price. So if we look at something like volatility, you can see how it's spiked up a little bit here. We were at the 20 range here recently. If you look over the last year, a lot of the action has happened between 14 and 12, and every time we get back down to those lows, we see a little VIX explode. Fears get greater and greater. I think a lot of that is psychological. I think people in general have become more fearful because the market's been strong for a long time, and people oftentimes are fighting the last battle. Everyone is so afraid of what happened in 2008 and 2009, but if you look at corporate strengths, their balance sheets, their earnings, and so forth, every time we get a hiccup around the world, the market has a little bit of fear, a little bit of a sell-off, but then it does come back. Every crisis has seen the market make new highs afterwards. I'm not going to be the guy that's going to try and pick the top in the marketplace, like I said. That's a fool's errand. But looking at the VIX, every time it bounces up, it gets smacked back down. So volatility is relatively low. So we want to talk about trading a strategy to take advantage of low relative volatility. Now, you're going to say, well, that wasn't low in the last chart. But if you look at a 5-year chart, look at where we've come from. 20 is still low, and it's not so long ago we were in the, we were at 12 just 5 or 6 sessions ago. So, volatility is relative, just like anything else. The market doesn't know high or low. And if you go back to 1996, volatility was below 10. So if the market breaks below that 12 level one more time, then that targets 10 on the downside, some new relative lows, and you can see the trend in volatility is lower, meaning that options are cheaper now than they were last year, the year before that, the year before that, the year before that. So in relative terms, options are of better value because that's one of the components that affects the premium price in an option. So let's get into the strategy, and we're talking about ETFs and how to take advantage of it. It's very, very simple. Very simple and efficient. The idea here is to use options so you're tying up less capital, you have less risk, potentially greater returns than buying or selling the stock. There's staying power to ride through the market ups and downs. Now, if you have a limited risk option that you paid $500 for and a stop loss in place at half of that, and you've got 6 months of time, when you see the market back off for a couple of days, it's not going to cause you or force you financially to exit the position. So that's an important point, that it gives you the ability to ride through some things and look at things on more of a weekly basis. That's what's important, more of a weekly basis. So let's look at the basics of options. Very simply, we're using options as a vehicle. Buying a call if we think it's going to go up, or buying a put if we think it's going to go down. Each option controls 100 shares. So it's much cheaper to buy an option for $500 than to buy 100 shares of the stock. And your maximum risk is what you pay for that option. So if you buy for $500, no matter what happens, if that company goes completely to zero, that option can only go from 500 to zero. We'll put in a stop loss at half of our premium. We'll talk about that in a second. But your maximum risk is known. You sleep at night. And it acts much like the stock in price movement if you select the right strike and the right option that's going to give you a good payoff. Important is that we want to trade liquid markets so that we can enter and exit efficiently and smoothly and have low overall trading costs. So let me give you my basic rules. Very simple. We're buying in-the-money options that have a delta of 75%. Delta is the only Greek I'm going to use here. And the delta is simply the movement in that option compared to the underlying. So if the ETF goes up $1, then that option will go up 75 cents. So it'll move almost what the underlying does. It's going to give you a good payoff. We want something that's got a good payoff. And also, the magic of that delta is, for our purposes, it's the probability that that option will be in the money at expiration. So that option has a 75% probability. If you remember earlier, I mentioned that I want to trade only positions that have a high probability. I want to make sure that I've got the odds on my side. So that's the first criteria. That I want an in-the-money option that's going to have a delta of 75% or higher. I want to make sure my break-even's $1.50 or less away, meaning that I modest move in the underlying stock or ETF. So if there's just a bump, I still gain. I'm not expecting a fantastic breakout. If it happens, great. We do very well. But I want to be in position to profit from only a modest move in the stock. And the key is to buy enough time to be right. We talked about buying time. And there's a big mathematical difference between buying 1 month at a time, 2 months at a time, 3 months at a time, and then going out. You'll see a big discount in the options in the front couple of, you'll see a discount in the options in the front couple of months, but it's not that dramatic between the front month options and the 3 month or 6 month options. Oftentimes you're better off to buy 6 months of time and pay that extra $30 or $50. $30 or $50 for an extra 3 months of time is a great value. So you want to buy enough time to be right. And mathematically, we'll put in a stop loss at 50% of whatever we pay. So we buy an option for $800, we'll put a stop at $400. Buy an option for $500, we put it at $250. The idea is anything can happen in the marketplace, but oftentimes, mathematically, if an option loses half of its value, either the market's gone the other way or you're running out of time, and those are two things that work against us. So we want to recoup our premium, have a salvage operation. If an option loses half of its value, we can always get back in, but we want to get out and conserve our money because there's an old saying here that, if I can remember it properly, that if you want to, you'd rather be on the ground than being up in the air in your plane wishing you were on the ground. No, I can't remember the saying. Well, anyways, the point is you'd rather be out looking to get back in than to be in hoping that you can get out, because hope is not a trading strategy. All right, let me give you an example here using the ETFs. ETFs as a vehicle, a way to participate in everything and anything now with this revolution in the marketplace. Let's look at gold. The gold miners ETF. Now you can trade gold, GLD. Now this is the miners. These are the companies, Newmont Mining and so forth, that make up gold. It tends to move in similar nature to the underlying asset itself, obviously, because they have so much asset on hand when it comes to gold. But it also seems to outperform on the upside and outperform on the downside. So oftentimes it's a better vehicle. Now this was back here earlier this summer, back in June. The market was down there near that support point at 22, recent lows at 20, trading within that range. So we're down there with the risk reward on the side of the bulls. So that was January 10th. You could see that GDX is trading at about $22.75. Now looking at that, the low for the year is $20. You could buy a 19 call, again, something in the money. The 19 call gives you the right to be long from 19. The market was trading at $22.75. So it had $3.75 of real value, and that option was trading for $4.40. Now, if you wanted to buy the shares, buy 100 shares, it's going to cost you $2,275. If you wanted to buy the option, it's going to cost you $440. So much less money tied up. It's going to perform just like, or very similar to, the GDX ETF anyways. So the stop loss on that option was at $220. Paying $440, that's your maximum risk. Stop loss at $220, so realistically you're really risking $200 on that trade. Now, if you look at it, in the middle of June, we were buying a January option. That was more than 6 months of time for good things to happen, something in the money, and the break even on this option was only 65 cents higher. The break even is calculated by taking that $19 strike. That gives you the right to be long from $19. The stock was trading at $22.75, so it's $3.75 in the money. So you subtract that from your cost at $4.40. The break even at expiration needed that stock to be at $23.40 at expiration would be the break even with 6 months to happen. So the key is to use the option as the vehicle, using this ETF to smooth out the idea of what's happening in the gold mining sector instead of one individual stock, because if there are bad earnings, if there's bad management, if there's some nonsense in accounting, that individual stock could get kicked. Where you're trading GDX, it's going to take a whole basket of those companies, and you're trading the whole group as a whole. So we bought that option at 440, boom. Short-term gain there. Typically, I'm looking long-term, and I wanted to illustrate this here, that you could see back in June where the yellow is, that we bought it at the bottom of that consolidation when it was around that 22 level, took off, 9 days, went absolutely straight up, took off. Now, options give you positive leverage. And as a trader, even though I had 6 months of time, when you get a significant return in a period of a couple days absolutely straight up, oftentimes it behooves us to take it. You can always get back in. Let's bank it. Let's put it in the bank. And that's what we did. I wanted to show you from a mathematical standpoint for our bullseye service what exactly happened. Now, we got in on the 10th, the 19th, 9 days later. Gold shot up. Gold went to $25.50. Now, that was a gain of 12%. That's a nice gain. 12%, you got to be happy with that. In a year, you'd be happy with that. But that happened in the stock in a period of 9 days. That's a beautiful move. But in the option gained 50%. We sold it at 660. We bought it at 440. We gained 50% on our option in a period of 9 days. Now let's review that. The beauty of that, and there's many of them, is that the stock went from $22.75 to $25.50. Nice move. The option had a 50% gain, and the total investment and risk was $440 with our stop at $220, so our risk was really $200. So the idea was we had less capital, less risk, and a greater return, and we slept very easy over that week and a half period of days with that trade on, because we were looking long term. We knew our break even was a modest amount with 6 months more of time for good things to happen. Now the delta on that option was 80%. So there was an 80% chance that that option would be in the money at expiration. So that puts odds in our favor. The idea here is to use the advantages of options. Less risk, less capital, greater return with our directional move. All right, let me show you one that we're into right now, and then we'll answer some questions as we go forward. But one of the positions we're in right now is we're coming into the middle of beginning of earnings season, and it usually gets kicked off with the financials. We start off with Wells Fargo, then JP Morgan, then Citigroup, then it goes Goldman Sachs, Morgan Stanley. All the big boys are usually at the beginning of earnings season. In earnings season, over the last couple of years, everybody gets so concerned that we're not going to be able to achieve it this earnings season. Well, the markets typically have a little bit of a dead period and a little bit of a backing off, and then usually, boom, we overachieve our low hurdles, and the markets take off. Well, who's done probably some of the best moves in the last couple of years after lagging for a while have been the financials, the banking stocks. They know how to make money. And if you look at it, the financial sector in 2007, the highs went from 38 all the way down to 8 or so, I think, in 2009. So the midpoint of that whole, all that action was around 22 or 23. We finally gotten to the midpoint of that sell-off. A lot of other sectors and indexes have made new highs. Now, the financial sector has barely recovered in comparison. I mean, it's bounced 50%, but there's still a lot more upside. And if you look at this chart, this shows you over the last 5 years where things are at. And this is what it looked like when we put on our position here. The XLF ETF, which controls the banks and the financials, was at about 22.90. You can see it had been trading between the 21 and 23 level, which targeted 25. So let's look at the trade there. XLF was trading at 22.90. The January of 2016 $19 call, just happens to be the $19 call again, was trading at 4.30. Now this was back October 10th when we initiated this position. Today, right now, it's January. We're coming on November, December, coming on 3 months that we've been in this position. But look at that. We bought it January of 2016. We bought 1 year and 3 months, 1 more year and 4 months of time in that option because the volatility was low and the option was relatively inexpensive. So that 19 call gives you the right to be long from 19 with the stock trading at $22.90. That's $3.90 in the money. So that option at $4.30 was only 40 cents higher. So if there was a modest 40-cent move in the next year and 3 months, that option was going to be above its break even. Now to buy the 100 shares of that stock, it cost you $2,290, or you buy the option for $400. So it's about 25% of the cost of tying up the money in the shares. And in the money option is going to behave much like the exchange traded fund. So buy the option for $430, put the stop loss at half at $215. It's going to act much like the stock and price movement. Now this is the market yesterday. You can see the market had made new highs above 25. Didn't quite get to our 50% profit. We were about 20 cents away from our 50% profit. But again, it's a January of 2016 option. So it's got staying power to ride through the ups and downs, ups and downs, ups and downs. And right now we're starting to recover once again. And we're significantly above our break even, in solid shape. It was at 24.08 yesterday. I think we're at 24.25 here this morning. So the option is doing very well. That option traded yesterday at 550. So 550, we bought it at 430. The ETF has moved 5%. That's a healthy gain, 5%. But the option is up 28%. Up 28%. So that shows you the power of options, the staying power, the leverage, the limited risk. And also, what I do in our service here is when a position gains 25%, we'll move our stop loss. We talked about how we put our stop loss at half of what we pay originally. I'll move our stop loss up, not to break even, because that you still need to give it some room to fluctuate, but I'll move the stop loss up from negative 50% to negative 25%. The idea is identify, execute, manage to maximize. That's part of the management process. And that's really probably the only money management we do. I may do it manually based on if I see something, but if the position moves in our favor, we're up 25%, I want to lock in some of those gains. I want to make sure that I lower my risk to minus 25%. So that's the basics of that. So let's just review the XLF position that we're currently in, looking for more gains, and have a January of 2016 option now that's up 30%, looking for more with our target at 50%, and the delta now is higher because it's further in the money. It'll start to accelerate as the market moves up, and it gets back up at about the 25.50 level. 25.35 I think is where our option will be worth. We'll have gained that 50% that we're looking for. So the gain in XLF so far has been 5%, from 22.90 to 24.10. That's a nice healthy move in a period of time in 3 months. Gotta like that. XLF option has gained 28%. Now the stop has been moved up to $320. So we still have some risk there with our stop loss down below, but it's been raised up to protect some of our gains. So to review, less capital, less risk, greater return. The delta now on that option was 80%, and we're up about 28% in that particular ETF with more upside potential. Now, I could talk all day about the different vehicles, but I want you to understand and focus on the approach that I'm using. I'm using the best vehicles to be successful. ETFs to smooth out risk with diversification, or to hone in on a specific target like a currency or a region or an interest rate or a commodity, anything very specific. But I'm using an ETF because of its liquidity, and then I'm using options on that ETF to control my probability, to give myself some staying power, and to position for a modest move, obviously looking for greater than a modest move, but making sure that my break even is not that far away. So I'll talk very quickly about the service and what we have to offer at Bullseye. But I just wanted to show you, I showed you a shorter term one, I showed you a longer term one, longer term trade, but I wanted to show you some specific examples. Even if I'm buying long-term options that have 1 year and 3 months, if a position has a significant move in a short period of time, I'm going to take it. And the program is geared to do that, to take advantage of the benefits of options and using those moves. Just because I have a lot of time, that's been somewhat of a concern for some people, that I've got so much time in these positions, I have that luxury of time for good things to happen. So the Bullseye Bar Chart Option Service is a trade alert service that will use options to limit your risk. We're not trying to be fancy or complicated or sophisticated. We want to create high probability trades using the positive leverage and options to get greater returns. They're very simple. Now, this is one example. I also do a cash secured put strategy as a way to get into stocks at a lower price or get paid not to. Again, taking advantage of probability. But there are option strategies and simple option strategies that you can use to take advantage of the market's direction, either up, down, or sideways. So there's no reason to make it complicated, no reason to make it difficult. And I think what is the key, these are more lifestyle trades. These are more swing trades or longer term trades that you can look at on a weekly basis. You don't need to worry about the minute by minute, day by day. And unfortunately, I think that's one of the downsides of the internet and getting access to information at all times. Everybody follows everything that happens in the world and in the market and gets overly nervous or overly excited at every single move or news story. Let's think big picture. Let's think period of weeks and months. And let's not worry about the nonsense or the noise that happens in the marketplace on a daily basis. Let's look at big picture, the overall trends. Look at the recovery that we had from the October lows. An amazing recovery. That was a shakeout. And what caused that? Ebola. How is Ebola going to impact the stock market? So you got to understand that people are emotionally on edge. We want to use that to our advantage. And that's one of the strategies when I talk about the cash secured puts. We use that heightened volatility as a way to get into stocks at a lower price. But we want to be able to manage our emotions and have a disciplined trading plan looking at the big picture. So let me tell you what you get with Barchart Bullseye Options. You get trade recommendations via email or text. You're going to get a couple of them a week, very detailed. The very specifics of the where and exactly what to get into and why. A long detailed report, not just buy this here, but an explanation of why and which option and which strike and which probability and what our expectations are with that. So a very in-detailed explanation. You get access to the online portfolio that tracks every trade so you can see how they're performing, how they've done in the past, how trades have done, how winners and losers, the time frames, and the probability of success. So you'll also get an email or a text alert when the trade should be closed. Now, the beauty of trading options is you can build your plan before you get in, where to get out if it goes for you, where to get out if it goes against you. So you're not using these as an exit strategy. You're not waiting for an alert to tell you to get out. There's never any emergency emails or things that you have to act on right away. This will just advise you to check your account to make sure that you exited either for your profit or for your stop out. When and if that happens, you'll get an alert generated. You also get a weekly recap of all open positions. And my weekly wrap-up talks about what happened during the week, what we're looking for to happen the next week, and so forth, and what's happening in the positions we're in. And there's also a live in the market webinar, every week, every Thursday at 4 o'clock Chicago time, 3 o'clock Eastern time, actually. So if you sign up today, you can get access to it, and we'll review the positions we're in, and we'll actively look for new trading candidates and why, and evaluate the best options to take advantage of some of our premises. So every week, and it's also a chance for you to ask questions and look over my shoulder, see what I'm looking at, see how I view the markets, send me questions, send me questions on individual stocks you're looking at. Maybe we can look at some different ways to take advantage of what you see in the marketplace. I'm not here to give advice, individual stock advice. I'm here to give you some guides and make sure that you understand the risks and maybe the best ways to take advantage of your outlook or my outlook on any individual stock or ETF or position. So you get 2 trades a week with a 14-day trial. You sign up with Bullseye/ETFS. You'll get 14-day trial, so you'll get 4 trade alerts at minimum. You'll get 2 one-hour live webinars and 2 weekly updates during that 2 weeks while you're on trial. So you also have access to the account, and after the 2-week trial, you'll subscribe for $99 a month, or if you're interested in getting a year, you get a year at a discount, obviously, instead of $99 a month, which would be $1,200 for less than $800. You're getting 4 months for free. So that rate right now is 30% off of the full rack rate, and that's the service that I offer. And like I said, I think what I can provide is my years of experience and my longer-term outlook and view of the marketplace. So if you have questions, That's what I can do for you right now. But please get a trial subscription at Barchart Bullseye Options, and I will see you, or hear you, and see you, I guess, in my weekly webinar here today. All right, now I'm going to answer some questions here. The trial price, you get free 14 days, but $99 a month after that. Can you talk us through a recent winning trade and a losing trade, explaining why you chose them? Well, the XLF was a recent one. I guess it is somewhat recent. It was back in October. Recently, just last week, entered into some positioning on Merck. Merck had an interesting chart pattern where it had been trading sideways, and if it broke above 60, it had a target at 66. It looks like we're about to take profits on that Merck position. So the stock has moved up about 7%. Now the option has gained 30 or 40%. Someone asked, how do you compute break even? You take your option price and add it to your strike price. That will tell you the break even at expiration. So if your option costs $5 and your strike price is $20, 20 gives you the right to be long at that strike at 20. 25 is where you need it to be at expiration. So you take your option premium and you add it on to the strike price, gives you the right to buy. So you want to make sure that you've got your break even at a reasonable level. I'm not looking to hit the home runs. The home runs will come. As they always say, look to hit singles, and the home runs will come. It's about having high probability trades on a regular basis, and you get into some that have some big moves. As far as a loser, what did we get stopped out of here recently? Got stopped out of something where we trailed the stop loss up and locked in 25%, and then we got stopped out when the market moved back the other way, but still it wasn't a full loss, it was just a 0.5% loss, and that's about the money management. FXE is a loss that I don't have a problem with because that was the euro currency. And the trend on the euro currency has been straight down, 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 and it looked like it was going to find some support around 124 or so. Never did. It's gone all the way down. It was at 117 today. So being stopped out is not a bad thing. As I've become, I wouldn't say more mature, but as I've aged, I've realized that not any one trade should have any impact on you in the long term. It's just one trade. It's about probability. It's about the portfolio of trades. Do you trade on puts too? Yes. Now puts, as we saw on the put side is much more challenging because when the market sells off, if you don't grab it within that first couple of days, you've seen the markets bounce back every single time. Right now, we're still in a bullish uptrend. That's why I did that analysis where I talked about all of the indexes and what we see, what we're looking at. Because you have to have a bullish bias. You absolutely positively have to. Some stocks, real strong momentum stocks, I would maybe put on a bear put spread, something of that nature. It says I have a gray screen. I don't know how to put up my PowerPoint without using it as an application. So I'm not exactly sure how to do that. No desktop sharing. Okay, there we go. Stop. Thank you. Stop. All right, so there's no application shared at this time. So I don't know what that means, but anyways, let me continue to answer questions. Can you show us how to read a chart? Well, that's a whole nother challenging, that's a whole nother class or aspect. Now, in my webinars, I do that. I'll evaluate the charts and why I see what I see and what we're looking for, where support is, resistance, retracements, what we're looking for as far as measured move objectives and so forth. And a lot of times what I look for on a chart is when the market makes new lows or an index makes new lows, does the volatility make new lows? Is there bullish divergence and so forth and so forth? Do you trade credit spreads? I do a credit spread on the cash secured puts. That's a way to get into the stock, but those are cash secured puts. I'll find a stock that has a low dollar price. Here recently, Cleveland Cliffs. Sold the $8 put, took in 50 cents or so. So that my cost basis was $7.50 when the all-time low was $7. So being long from $7.50, I'm not afraid of that. And then once I do get into it, then I can sell covered calls as a way to continually lower my cost and look for that market to move up. So there are some credit spreads. I'll use whatever strategy is appropriate for the marketplace. And right now we've been in a very solid uptrend for the last 5 years. Volatility is not that is relatively low, so credit spreads haven't been giving us a whole lot of payout. So a lot of times it's not worth it. But I'll trade whatever simple strategy we can use to accomplish our means, whether we see the stock or an index going up, down, or sideways. All right, no applications shared at this time. So how long is the 14-day trial good for? Can I sign up next week? Yes, you still can. Make sure that you have the right. Someone wants to know about the basic options, weekly options, the ABC of options, all a theory. It looks so complicated. Thank you. Very simply. Again, I'm using options as the vehicle. A call gives you the right to be long. A put gives you the right to be short. That's it. Very simply. If someone could give me a little bit of help here, I'm not sure. Someone says no screen showing. What am I supposed to be showing at this point? If Yana, if you could maybe just put up something from TradePub, I'd appreciate that. Because to be able to read the questions, there we go. I appreciate. There we go. Huge open interest in the 200 strike SPY for January 9th. Are they gamblers? When you talk about the spiders or the indexes, you can't use unusual option volume as much of an indicator. Yesterday, I saw unusual option volume come across in Juniper. A bunch of 6,000 of the Juniper 22.5 calls were put on when the open interest was only 300, and they were for this week. They were for expiration tomorrow. So somebody thinks they know something, or someone has the smart money's got a good inclination. But when you look at the spiders or some of the other indexes, they may be using those positions as a hedge for their stock position. You don't know their motivation. You see it on an individual stock. Oftentimes, it's someone that's got a large, someone that has a, how shall I say politely, a good idea of what they think is going to happen in a stock. And if you have the smart money, if you have a good idea what you think is going to happen in the stock, you're going to use an option because it's going to give you the best payoff. You've got lower risk. You can get in and out, and it's a better way to take advantage of something. How much of a spread between the bid and ask can you find to be excessive? Well, when I was a trader, young trader, the OEX options used to have a $3 difference between the bid and the offer. A lot of times, I don't want a bid and offer difference of any more than 20 or 30 cents. But in the same light, 20 or 30 cents is not a big deal if you're looking to be in a position for a year and a half. It's 20 or $30 per option. I look to split the difference of the two, and there's so many people on the bid, so many people on the ask. A lot of times, if you put in a price in the middle, that you'll get picked up, and you should be fine. So. Those are just some of the mechanics of the options, but if you look at any of my reports, it's a very, very detailed report and talks about the option strategy at length, and each and every one of those reports will give you the background and the understanding that you need to get up to speed in options. How do you set the stop loss on an option? Every brokerage firm is different, but you want to put it on the option itself. So when it trades at that price or below, your order becomes a market order. And again, we're trading good liquid options. There's a lot of buyers, a lot of sellers, so you'll be able to get in and out smoothly and very, very close to your exit point, to your stop loss price. Because again, when you want to get out, there are plenty of people that want to get in, and we're trading it we're exiting or trading based upon the option, not the underlying stock for this service. Someone asks about the VIX and the VXX. Well, I use the VIX as nothing more than an indicator. What's going on with the VIX and the months and the VXX and the futures is a lot going on there. And so I use the VIX as an indicator. Is volatility high or is volatility low? And that'll help me determine what strategy I want to use. Do I want to use a credit strategy? Do I want to be buying options because they're a good value? Do I want to be doing some sort of a spread strategy to help alleviate my cost? Someone asked, says, actually park the stop order instead of an alert and do it yourself. Isn't that the way to get dinged out all the time? Not the way the current markets work. Now, that's kind of how things may have happened in the past. There's no one there. I know that people have this vision of a big, giant, evil beast that's there to see your stop and stop you out. And again, you have to understand that there are many, many participants in the options markets to make the market, to make a bid and make an ask. So the bid and ask are not going to evaporate, and they're going to go down and stop you out, and then it's going to come back. You want to put it in position so you don't have to worry and wait or watch anything, that you've got your stop loss in place. Again, we're looking for weeks and months. Someone asked me if I was on WiseTrade. Yes, WiseTrade. Yes, sir. I helped develop the futures software for them, the subscription-based future software for WiseTrade. That was good fun, great time, good people. I do miss Dallas on a day like today when it's -7 degrees before the wind chill. Guess it only. I'm not even going to use that word, flash crash. That was a very, very unique situation. And you know what? On something like that, I'd rather be out and trying to figure out why I got knocked out than not be out and worrying about what the heck is happening. Do you buy at the money? I mostly buy these in the money options. Again, that raises the probability. Probability is something you can control. You can control. If you want to buy an at the money option, you've got a 50-50 chance. Why not spend a little bit more money and buy an in the money option that raises your probability to 75 or 80%? And again, by doing so, that moves our break even to a very reasonable amount. So if the stock or ETF moves up 50 cents, 75 cents, a buck, we're going to be profitable. We're not waiting for a big move in the stock to get yourself in the green. We're going to take advantage of it. Someone asked about me trading options. Yes, options are the way to go. Options have so many mathematical advantages. If you're trading anything else, you've got direction. You're either right or you're wrong. There's nothing else. There are many other variables that can help you. And again, you can trade and take advantage of time decay. You can take advantage of volatility changes. You can take advantage of direction. You can take advantage of so many different aspects when it comes to options. Whereas you're trading the straight, it's either up or down. You're either right or wrong. Please repeat your criteria for buying an option. Okay, first criteria is I'm going to buy an in-the-money option that has a delta of 75%. So I'm buying an in-the-money option that's going to act like the underlying. It could be gold, it could be SPY, it could be QQQ. We're talking about ETFs today. It could be GLD. You know, I'm going to buy an in-the-money option instead of buying the shares of that ETF. Each option controls 100 shares. And I'm going to buy more time than I need. I'm going to buy at least 3 to 6 months time if I'm looking to go long on a call. So therefore, even if I expect something to happen in a short period of time, the difference monetarily between a 1-month option and a 3-month option is typically, usually, just a few dollars. So I'm going to buy more time than I need. So I'm buying at least 3 months of time, typically at least 6 months of time because volatility is relatively low in comparison to what it's been in the last few years. And then I want to make sure my break-even's $1.50 or less away, meaning that the underlying only has to move up $1.50 or less for me to be at expiration profitable. So I've got plenty of time, and I'm going to profit from just a modest move. Someone has a concern that the sound issues are buggy. Well, hopefully that answers that. Thank you. Someone tells that it's Daniel because I think you can hear my nasally voice, my Chicago or my Canadian accent, from being from Upper Michigan. So I really can't complain about this cold weather. Where I'm from, I'm sure it's much colder, but it doesn't mean that I like it. I was going to see what other questions we have here, and it looks like my time is just about up. If there are any specifics about this strategy or about the bar chart bullseye service, let me go back onto the slideshow again and upload. Okay, so I had it as a desktop sharing. So let me just go to the application so you can see the there we go. So if your delta is minimum of 70, 80, how far in months do you go? Again, 3 to 6 months, ideally, is what we're looking for. So there we go. And I want to go to the last slide. There we go. So I didn't upload properly. I just using this this movement here over to my projector, projecting my monitor. So you can see there's the link to sign up. Hopefully I'll see everybody today at 4 o'clock Chicago time for our weekly webinar. You can ask questions on specific stocks, strategies, anything concerning the marketplace. Look for me on TV, on Fox, on Bloomberg, on CNBC. I'll be on CNBC on Monday morning at 4:50 Central Time if anybody's interested. Bright and early, but I got to be optimistic about the way that the market's followed through so far today. The last time I looked at it anyways, after yesterday's reversal, that was a tough beginning to 2015. But the reality is, even though it felt like a lot more, it was only down 1.5% or so after yesterday. So wasn't that big of that big of a sell-off. It just felt like it was with that. So let's see if there's any more questions. Do you also do straddles and strangles? Sometimes what I do, I'll use straddles or strangles as a play to position for a breakout with an earnings play. Someone asked also about how many options you want. I always tell people to learn how to trade and trade one option at a time. Then you can always become a bigger, better trader. You know, the idea is to learn the mechanics, learn the disciplines, and get comfortable, because it's not something you want to learn trading 10 options at a time and then, you know, have less money to work with. So start with one option and then build from there. But as far as your brokerage goes, some brokerages aren't specializing in options, and they'll authorize you for different levels. Two brokerages that I recommend that are option specialists are Trade Monster and Thinkorswim. And they'll let you trade, you know, with the money that you have in your account, and there's not any authorizations for spreads and so forth. But as far as do you sell options, not anything naked unless it's a cash secured naked put as a way to get into a stock, because there's a limited downside on if you sell a put on a $5 stock, what's the downside? You know, but I won't do any naked positions because it's all about controlling risk. I want to know what my risk is on any position. I'll do some sort of spreads. But I won't do any naked positions, because there's no reason to set yourself up for just a black swan possible catastrophic loss. That's the idea here. No catastrophic loss. Your suggestion of an account size, I don't have a suggestion on the account size. What I have a suggestion is to divide your account into 20 pieces of pie. So if you have 20 pieces in your account and you're risking half on each piece of pie, then your maximum exposure is only 5% on each and every trade. So that if that trade goes bad, you've got 95% of your account left. The profit target for each trade, mostly the profit targets are set at 50%. Someone asked about Option Express. Any brokerage that obviously specializes in options, where sometimes people, you know, there are some brokerages that aren't going to be option friendly. Is that a good way to say it? Option friendly. So, 14-day trial, sign up for that. Someone had asked about ZEE. I don't have my projector set up to be able to evaluate here. And so I won't be able to do so. Is there any repair strategy, repair a sell option if it goes against you, expiration if you trade oil before they tank? Nope, got a stop loss, being out. Out is always the best answer. I don't want to try and make it complicated. You know, all you're doing is, you know, holding on or trying to delay the inevitable. You know, you had your plan, it didn't go. You're out. That's the way you want to look at it. How many days before earnings the implied volatility increases? Typically, if I'm looking for a straddle or strangle to take advantage of an earnings breakout and something to happen, the volatility increases the couple of weeks before the earnings. So I'll typically want to do it at least 3 weeks before an earnings number, so that you'll see that volatility increase, and that'll benefit in the near term, and then look for a breakout move in the long run. Terry says Jared Levy. Jared Levy was my partner in crime back in Dallas. He used to do business with Options House. Options House is merging with Trade Monster. I love the Trade Monster platform. just because it's option friendly. That's what they do. It's options. Once you understand the very basics of options, you'll never go back to not trading options. There's no reason to buy or sell outright when you can use options as your vehicle. And a light bulb will go off. Yeah, they have merged, and now they're Wonder Twin powers as far as Options House go and Trade Monster. And Nigerian, Mr. John Nigerian, has made his business of unusual option activity. That's what he's on CNBC for. He'll talk about how options are the eyes of the smart money. They're going to use options as their vehicle. And I don't know about TradeStation. I never used TradeStation. Right now all electronic brokers are very similar. I just try and dissuade people from trading with someone who is not option friendly. That's all. Sometimes you get some money management firms that just kind of want you to sit on your money and invest in things long term. Again, this is a more active portfolio, so commission becomes a factor. But paying $10, $15 commission, it's not about finding the lowest commission. Commissions actually perform a function, believe it or not. And I know it's silly to say, but if you didn't have to pay commission, you wouldn't think about getting in and out. You'd be less disciplined. You wouldn't stick to your trading plan. So understand that it's there for a reason. Did you say you always own the underlying ETF when trading the options? No, the options control the underlying ETF. Instead of buying 100 shares of the QQQs, I could buy the QQQ options. And actually, the Qs, one of the positions we're recently in, the 102 call, the 98 calls, 102 has been a support point. That was the last high back in September, and that's kind of held as a support point here. And that 100 level is what we're leaning on. And if it has a V recovery back above the 106 level, then that target's 110. So there's upside potential in the Qs. The trend is strong, and there's a good solid support point to lean on. So the risk reward is favored in being bullish. And in that instant, using the 98 calls for, I think it was April, gives us some time for good things to happen there. Can you recommend a U.S. platform, Canadians? I'm not exactly sure. Take a look around. Like I said, check with Thinkorswim. I think they may have a Canada division. Check with Trade Monster as far as how they do foreign accounts. I know we don't consider Canada foreign, but technically I guess it is. Do you ever trade anything naked? The only thing naked gets you in trouble. The only thing naked is cash secured puts as a way to get into a stock lower. Now to go through an example of that quickly here, if I like a company and I want to buy it, but I want to buy it lower. Let's say I like PBR. All right, that stock's gotten smashed, crushed, slammed. Petro Brazil. Okay? Oil has a certain value at some point. We don't know what that point is, and obviously oil is a very emotional market. It's gotten beaten down more so than probably makes sense. But let's say I want to buy PBR and it's trading at 7. Okay? Sold the 7 puts, took in 50 cents. All right, sold the 7 puts because the volatility is heightened, the fear is there. Instead of buying a put, I sold a put as a way to get into the stock at a lower level. A put gives someone else the right to be short, so that has me an obligation for the upside. So if the stock goes down, I would be assigned a long position at $7. All right, minus the 50 cents that I took in premium. So my basis would be $6.50. So I'm using it as a way to get into the stock at $6.50 or to get paid not to. Or I get to keep that $50, that 50 cents. That $50 based on my risk is $6.50 is a pretty healthy return on risk in a short period of time. I sell front month options as a way to get into stocks at a lower level. People could do it on Apple. People could do it on Tesla. If you have the money in your account, you want to buy the 100 shares, sell an option on a stock that you want to own. Again, the key is that you want to own it. You sell a cash secured put, meaning that you have the money in your account as a way to get into it lower instead of placing a limit order. On Apple, you could say, I want to buy it, at 100. Or you can wait till it gets to you at 100. Or you could sell a 100 put and you would be assigned long if that happens. And if it doesn't, and the option expires, you could keep the money. Then you sell a put for February. Keep the money. Sell a put for March, and so forth. The only downside is it may never get to you. It may never get you put to it. And that's the same thing as a limit order. A limit order may never get it put to you either. So that's something to think about. If you never buy a stock, will you sell a put to buy a stock? Best way to buy a stock. Yes, I would sell a put as a way to buy a stock at a lower level. That is part of an option wheel. It's one of the strategies that I use in options. Very simply, use it as a way to get into a stock at a discount. And once we get it put to us, then obviously the volatility has increased. And typically this is when volatility on the individual company is at 50% or higher. So in some of the positions right now, Cleveland Cliffs, or Cliffs Natural Resources anyways. What were some of the other ones here? I just mentioned PBR. JCPenney was one of them, where you're selling puts on single-digit stocks, knowing that your worst-case scenario is if you sell a $7 put in PBR and your break-even $650, that's $650 that you have to have in your account that's tied up in that option, in that stock. And you're prepared to own that stock for the long term, to put it in your portfolio and wait for it to appreciate. And what you do is then, if you get it assigned to you, then you sell an out-of-the-money call against it to create a covered call and lower your basis once again. So your basis goes from 650 down to 625. And then the next month you sell another call. You sell another call and continue to do that until it gets taken out. So you sell a put as a way to get into it, get assigned the stock, then sell covered call as a way to get out of it, and then repeat. So you do it on single-digit stocks with high volatility to use as a way to trade those individual stocks. But I want to get back to the straightforward using options as a vehicle. So you want to use the option, a good in-the-money option that's going to behave like buying or selling the underlying stock or ETF. Today we talked about some of these ETFs, and the revolution of the ETFs has changed everything. There are ETFs that follow every sector, every marketplace, every commodity, every financial instrument. There's an exchange-traded fund that you can use as your vehicle, and the options on that allow you to increase your probability and give you the staying power, give you greater returns and less risk. And that's the whole idea behind this. The question again, for the criteria for open interest and volume. I want to make sure that the bid-ask spread on the option is not more than 30 cents. Not more than 30 cents, just because I want to make sure there's good liquidity getting in, getting out. Again, a lot of times we're looking at the long term. So that $20 or $30 in that option premium isn't really the issue, but the issue is making sure that there's enough participants, enough buyers and enough sellers. It's just like you would do in an individual stock. You want to make sure that the stock trades, in pennies, not trading in 10-cent increments or something of that nature. That just tells you, how liquid the markets are, so how efficient your trading plan execution can be. So I can see everybody is answering some questions here on possible brokerages. Thank you, Yana, for keep putting that up, because it gets clicked off the screen. I'm going to finish up here. My time is up, but let me just put this on the board one more time, and look forward to seeing everybody in our live webinar this afternoon. And ask more questions. Sign up for the 14-day trial right there, barchart/bullseye/ETFS. And I will talk to you soon. Thank you very much, Yana. Thank you, everyone at Trading Pub. Great production. I appreciate it very much.
Well, thank you, Alan, for that crystal clear presentation on how you use limited risk option strategy